Hello again, traders. Doing over there from DRFX, Swing Trading Mentoring. Gonna be taking a look at a recent trade that was made on the pound US dollar, which provided me and my subscribers with a trading gain of 42 pips and a rate of return of 2% on my live account, as we took advantage of the formation of a consolidation setup on the daily chart of this currency pair, which created a strong and sharp downtrend on this currency pair over the last several days. So I'm going to be taking a look at the main technical factors that supported this trade on both its daily chart and 4-hour chart, to essentially show you once again the main advantages of using Japanese Candlestick Signals, trend lines and consolidation setups on the daily and 4-hour charts, in allowing us to accurately identify market direction and to maximize on the trading gains provided by these time frames ahead of sharp reversals, so that you can remain profitable and successful over the long term in this trillion-dollar market. Now, as you will see in a section on my website that describes the new trading approach that began in February of this year, essentially what we do now is to target trading gains of between 50 and 70 pips within 24 hours, using the accurate candlestick patterns and signals of the daily and 4-hour charts. Where possible, we also target high probability setups that provide us with trading gains of between 70 pips and 100 pips, and extend the holding period from 24 hours to 48 hours, in order to be able to capture these larger pip movements provided by the market. Here you can see the graphical representation of this new trading approach, where for the most part we target trading gains of between 50 and 70 pips. As I said before, where justified, we also target trading gains of between 70 pips and 100 pips. And on the other side of the range, such as was the case with the pound US dollar that we're going to be taking a look at, we also target trading opportunities that are provided that are less than 50 pips. Market direction is identified using the signals and patterns provided by the daily chart and the 4-hour chart. And once an entry opportunity has been identified, entry then takes place using the signals and patterns provided by the 4-hour chart. Of course, no trade is complete without a strong stop loss. And to protect the trade against temporary pullbacks until our trading targets are hit, what we do is to use the strong stop loss areas of trend lines, support and resistance of consolidation boundaries, as well as the highs and lows of candlestick formations on the 4-hour chart to protect the trade until our trading targets are hit. Now, the overall approach that I've been using to trade the currency market over the last 10 years is that of trading within the context of the weekly ranges and the monthly ranges of currency pairs. What I've discovered is that all currency pairs have weekly ranges and monthly ranges that they trade towards, that they move towards. Weekly ranges are average pip movements that take place over a 5-day to 9-day period, sometimes less. And monthly ranges are basically the average pip movements that take place within a 3-week to 6-week period. So there are 2 weekly ranges that a currency would move by. It will move by the first weekly range and then pull back and pause, and then move by a second weekly range movement to complete its weekly range for over the 3-week to 6-week period. So what is done in the short term in terms of the new trading strategy, which targets short-term movements, is to target trading opportunities that take place within the context of these 2 weekly range movements that take place over a 5-day to 9-day period for each currency pair. So here you can see in this table from the trading manual once again the average pip movements for the major currency pairs and the corresponding both the weekly and the monthly ranges of these currency pairs. So other currency pairs that are outside of this, that are not in this table, also have their respective weekly and monthly ranges. And it is very important to be able to not only predict market direction, but to anticipate and identify exactly the expected pip movements, so that we do not enter the market too close to the end of these ranges, which, when they are hit, normally lead to temporary and sometimes sharp pullbacks once these targets are hit. So this is the overall approach. Years ago, I used to trade between 100 and 200 pips within the context of these movements. But the focus now is to target trading gains of between 50 and 70 pips. And the maximum that I would aim for within the context of these movements is up to 100 pips. Now, in terms of the setups that are traded within the context of the new trading approach, which began in February of this year, there are actually 3 setups, and all of them are done within the context of consolidation. The first is that instead of waiting until the consolidation has been completed and then trading between the boundaries of resistance and support, which is very common and a very common approach that most traders take, what we actually do is to trade the early waves that lead to the formation of consolidation. Now, what I've discovered, as you will see in the trading manual once again, is that the market provides us with signs that it's going to be forming consolidation and that it's transitioning from a trending market to a consolidating market. So what you will see is that the market provides us with certain types of bearish and bullish waves that indicate that the market is going to be forming consolidation. And so instead of simply pausing or trading and waiting until the consolidation has been completed and then trading between the boundaries of resistance and support, we can get an early move advantage, so to speak, and capture additional trading gains, early trading gains, by trading these early waves that lead to the formation of consolidation. Of course, once the consolidation has been completely formed, trading then continues by trading between the boundaries of resistance and support. So here you can see from the trading manual the 4 main types of setups that I trade. Ranges are basically where the market will move sideways and allow us to form horizontal boundaries of resistance and support. And pennants, these are where the market will form 3 main types of pennants depending on the angle of the resistance and the support boundaries that are formed. The third setup is where we trade false consolidation breakout reversals, which, as you know, takes place when the market fails to break out at one end of the consolidation and then reverses and heads back inside of the consolidation. Now, what I've discovered is that there are actually 5 technical factors that help us to predict when the market is going to be starting these false consolidation reversals. So once we see any of those 5 factors present on the currency pair that we're looking at, then we can anticipate that the breakout that is taking place is not going to be a false one. Avoid trading that breakout signal and simply wait until the reversal signal has been provided and then trade it and take advantage of the movement as it heads back inside of the consolidation. So these are the 3 main setups that are now the focus of my trading approach. As you'll notice, I have not mentioned anything with regards to breakouts. The reason for this is that even though I used to trade them several years ago, I no longer trade them because what I've discovered is that they are becoming a lot less frequent, and when they do take place, they're taking place with a lot more volatility and unpredictability. So what I found is that when they do take place, if you enter the market, instead of comfortably capturing a trading gain of between 100 pips and 200 pips, which is what I used to do, what I found is that once I've entered the market, there's less certainty that the market is actually going to be hitting that target. And in most cases, if it does, it is going to be doing it in a volatile way. But what I found is that in most cases, it also does not break out by much and starts to reverse and heads back inside of the consolidation. So what I've discovered is that movements and patterns that take place within the context of the formation of consolidation, or that take place once a consolidation has been formed, these movements within the context of consolidation are a lot more predictable and provide a lot more reliable signals compared to those signals provided by consolidation breakouts. So these are the 3 setups that are the focus of my trading approach, and they provide a lot more profitability because of the stability and the reliability of the signals provided by the daily chart and the forward chart. Now, in terms of the trading platforms that I use, over the years, I've been using FXCM to identify market direction and trading opportunities based on the New York close of the daily candlestick signal. Now, even though other platforms also use this candle, which is crucial to candlestick pattern methodologies like mine, I've discovered that this platform is a lot more user-friendly in terms of chart analysis and in terms of the accuracy of this New York close of the daily candlestick signal. However, in terms of my live trading, I previously used Ducascopy up to 2016 and have transitioned to using FX Pro for two main reasons. The first is that the exact risk and percentage values, risk and return values can be seen in terms of percentage values when you're actually executing a trade, which of course helps to ensure that you can actually ensure that you're staying within the risk parameters that you have established for your trading. So you can ensure that you're going to be trading less than the minimum, less than the maximum in terms of your stop loss and your risk, and that you are able to capture a minimum return that you have set to justify a trading opportunity. The second reason is that you can actually receive email alerts, and this is very important because what it does is that instead of actually having to monitor the trade and constantly be tied to the monitor, looking at the market until the trading target has been hit, you can simply close the platform and wait until the email alert informs you that the trading target has been hit. This prevents the bad habit, which I think has been developed by day trading, where we are tempted to constantly monitor the market, and because our trading range and our time frame in terms of our targets is so small on day trading and on smaller time frames, it is very tempting for us to be monitoring the market to ensure that our trading target has been hit within a very short period of time. What this bad habit does is that because the nature of the market is to move sideways and to pull back from time to time, it is very easy to be tempted to close our trade, just because we see temporary movements against our trading position. Now, what this does is that even though it can help us to reduce the size of our losses and prevent our stop losses from being triggered, what it does is that on the other side of the fence, so to speak, on the other side, it reduces our profit potential over the long term, because you will not be giving the market the chance to actually hit your trading target. So to prevent that bad habit, it is best to choose a platform that allows you to close the platform and simply receive an email alert informing you that the trade has been completed. So the main advantage of using this approach on the larger time frames and my methodology in general is that you're able to take advantage of stable time frames, stable signals, and reliable entry signals, which of course increases your trading and forecasting accuracy on these time frames. And because you're trading, and because I am actually targeting high probability setups, trading is done only 1 to 2 times per week, targeting trading gains of between 3% and 4% on average per trade. So what this means is that you do not really need a lot of trading to be done on a weekly basis or a monthly basis in order to be able to capture a large rate of return each month and over the long term. Now, in terms of the trading gain that was captured on a pound US dollar, here you can see the summary of this trading results, where we captured a trading gain of 42 pips, which for most traders would have represented a rate of return of anywhere between 1% and 3%, depending on the level of risk that you would have taken for this trade. And as you can see here for me on my live account, this actually represented a rate of return of 2%. Now, this trade actually compensated for an earlier loss that was taken earlier in the downtrend on this currency pair, which we're going to take a look at. And so what this means is that we had a little bit of a setback, but nevertheless, we still, as you can see here, have a positive trend of trading results over the last several weeks and months based on the current methodology that is now being used. What this has translated into is a still strong rate of return of 21.6% on my live account, which represents the performance of this live account since the new methodology began in February of this year. So here you can see that up to that initial loss on the pound US dollar, the rate of return was at 24.35%. And so this loss pushed it down a little bit below 20%. And the trading gain that we were able to capture allowed us to head back above the 20% mark and capture and essentially registered this current rate of return of 21.59%. Now, this is a strong rate of return, and it means that we're still fairly close to hitting the 30% target, which is the next major target. This 21.6% rate of return is also very comparable to and ranks favorably with the top returns of the top currency traders as ranked by Barclay Hedge over the last 3 years. So here you can see the top traders and their rate of return in 2015. And you can see that the current rate of return of 21.6% on my live account is fairly close to these top returns back in 2015. 2016, also comparable to these rate of returns, above these rate of returns here, and is now closing on the rate of returns of the top 3 in 2016. And in 2017, rate of return is now at the just within this area here, at the just below the rate of return of the top 2 currency funds in 2017. 2018 is not yet available as yet, but given the average rate of returns so far for these top currency traders over the last 3 years, it means that 2018 is likely to be the same, and that the current rate of return on my live account can be viewed very favorably in the light of these rate of returns from these top hedge funds and CTA programs. So based on the current rate of return, and assuming that the next set of trades provide a rate of return of, I would say, anywhere between 3% and 4% each, then it means that I'm just 3 trades away from the 30% goal, 7 trades away from the 48% goal, and 21 trades away from the rate of return of 119%. Now, this table represents my rate of return targets, which assume a rate of return of 7% on a monthly basis. So the 7% monthly rate of return is expected to be hit. 7% monthly rate of return is the trading target over 12 months. And so these 6 trades, these 6 targets are basically a summary of the 7% monthly rate of return target over a 12-month period. Now, in terms of the trade itself that was done on a pound US dollar, this was done in the context of a consolidation setup that appeared to be forming on the daily chart. Here you can see the daily chart of this setup where the market had been forming provided these bearish and bullish waves, and had recently U-turned like this with these setups and these signals to indicate the possible formation of a consolidation in the form of a pennant. So given the formation, given this possibility, and the double top signals as well as this bearish signal, it was very likely that the market was at least going to be heading towards the support boundary as part of the formation of this consolidation setup. So given the likelihood of the movement bearish towards the support area at 129.21, a trading opportunity was then looked at on the 4-hour chart to take advantage of this movement. Now here you can see on the 4-hour chart that the market had actually formed, you can see the double tops as well on the 4-hour chart as well, and had created this downtrend as well as this downtrend line as part of this movement. So to take advantage of this movement, what was done was to use the downtrend line as a strong stop loss area, and the stop loss was placed at 1.3106 with entry taking place at the close of this candle on the 4-hour chart, and the target set to capture a trading gain of, this would have been equivalent of around 93 pips, as we targeted 1.2923 just above the support point of 1.2921. So with that setup identified, a trade signal was sent to my subscribers, providing the details and the theories behind the trade. However, well, before I get to the trading loss, this was the setup. This was the basic summary of the trade. Daily chart was forming a pennant setup. Double tops and bearish signals were provided by the daily chart and the 4-hour chart. Support target of 1.2921 was set, and entry took place on a 4-hour chart to target a trading gain just above this support point. However, instead of heading towards our support target, the market, as you can see here, pulled back fairly sharply and actually took out the stop loss here, and led to this trading loss of 4.11% and 87 pips. So Despite that pullback, however, so this was the initial loss, market pullback, but because of the strength of the downtrend on the daily chart, it was therefore no surprise that the market eventually provided us with another entry signal, another bear signal, which took place in the form of this break of this counter trend line. So with this strong signal, it provided us with a second opportunity to take advantage of this downtrend before it ended. And so entry took place at the close of this candle with a stop loss placed once again above the downtrend line and the trading target set at 1.2925. And in this case, we actually were able to capture this trading gain of 42 pips, and we're able to stay in the trade this time, as even though the market pulled back sharply once again, the stop loss was placed at a more comfortable distance above the trend line compared to what was done on the previous entry. So as you can see here, this was a typical example of why we should not watch our trade. You can see that even though the market provided us with a strong signal and that there was a very short distance to hitting the target, you can actually see that the market came within. The low here was actually 1.35, which was 10 pips ahead of the trading target. So if you were monitoring the trade and we're looking at the trade here, and you would have seen the market pull back just before hitting your trading target, you would have inevitably begun to worry and to anticipate that the market was going to take away your trade. And many traders would have probably exited the trade at this area here to minimize on a possibility of a trading loss, thinking that the market was not going to be hitting the target. But as you can see here, because of the strength of the downtrend and because the ultimate target was going to be the support point, the market was eventually going to return, which it did here, and it did so, and eventually hit our trading target at 1.2925 as it hit the support boundary of 1.2921. So this was the trading alert that was provided by FX Pro, informing me that the trading target had been hit and that we had got 42 pips from this trade, which, as I said before, was able to compensate for the initial trading loss. Now here's where the analysis gets interesting. As I said before, I do the analysis on the FXCM platform and my live trades on the FX Pro platform, but I also trade both. All setups that I trade are done both on the FXCM demo account as well as on the FX Pro live account. Now what happened here is that, as you can see here, entry took place at this area here, which was the original entry area, and you can see here that the market pulled back. And so even though the stop loss was placed at the exact same area on the FXCM platform as it was on my FX Pro platform, this stop loss was not triggered. The reason for this is that the pip spread on this FXCM demo account was actually wider, which of course means that the stop loss was not triggered. So it means that it did not rally enough to be able to trigger the stop loss. So the stop loss was still holding, whereas on the live account that I had, because the pip spread was smaller, it meant that it was easier for the market to actually trigger the stop loss. So as you can see here, that we were still in the trade on the demo account, and it was still holding all the way through this U-turn, all the way through this second pullback here, until the trading target was hit. And as you can see here, this actually would have provided us with a 93 pip trading gain. So one of the reasons why I believe that even though technically speaking, the reason for this loss on the FX Pro live account had to do with the smaller pip spread. I think that the main reason had to do with the mistake on my part of not placing the stop loss high enough above the candlestick signal. So even though it was placed above the trend line, it was not placed comfortably above the high of this bear candle, which was the signal. So as you can see here, on the second approach, on the second entry signal, mistake was corrected, and the stop loss was placed much more comfortably above the downtrend and above the high of this candlestick signal that was given. So you can see this was able to withstand the pullback that took place ahead of the U-turn that eventually led to the trading target being hit. So as you can see here, FXCM demo account got all of the trading gain that we initially targeted of 93 pips. However, on my live account, and for some traders, depending on the pip spread, of course, on their particular trading platform, they would have been able to capture all of this trading gain. But unfortunately, for others like myself, we initially incurred this trading loss and had to make up for it with this trading gain of 42 pips. And on my live account, this represented a rate of return of 2%, which helped to cut this loss in half of 4.11%. So overall, this was the overall context of the trade. The market was expected to form a consolidation in the form of a pennant based on the nature of the signals provided by the daily chart, and was expected to head towards the support point at 1.2921 as part of the formation of consolidation and in response to these double tops and this bearish signal that was given. And as you can see here, the market declined as predicted towards the support boundary and would have provided us with a strong trading gain of 93 pips. But nevertheless, we were still able to capture a trading gain of 42 pips that helped to compensate for the initial loss. Now, in terms of the use of trend lines and consolidation of trend lines and downtrends for stop loss placement, you will see here that counter trend lines are very useful in terms of trends and in terms of stop loss. So what we do is that when the market U-turns, they provide good entry signals to indicate the continuation of a trend, as well as an opportunity to place our stop loss at the highs of trend lines that are formed as part of these counter trend line setups. Downtrends, which are formed as part of these counter trend lines as part of trends, these provide strong stop loss areas that help us to protect the trade, especially when they're formed on the forward chart as well as on the daily chart. Trend lines formed on the smaller charts, not really that reliable in terms of stop loss placement, and those can easily be taken out by temporary pullbacks. So the key, as I said before, to ensuring that we stay in the trade is to place a stop loss comfortably above the downtrend line and above these counter trend line setups to ensure that we stay in the trade and that we are able to withstand these temporary pullbacks until our trading targets are hit. So as you can see here, the key important thing is to place our stop loss comfortably above these trend lines and comfortably above the signal that was given as part of the breakout below these counter trend line setups. So with downtrend lines on the smaller time frames, you may have seen trend lines on the smaller time frames that would have been formed at this area here, and these would have been easily broken, and these would have led many persons on the smaller time frame to anticipate that an uptrend was going to be starting. But because of the focus on the larger time frames and the expectation of this major target being hit, it was therefore likely that the market was going to continue in this bearish direction and eventually hit this support target. So what are the main highlights of this trade, or of these two trades, to be more precise? Basically what it shows is that we can take advantage of the formation of consolidation setup on the daily chart by trading the bearish and the bullish signals that are provided by the daily chart and the forward chart. Downtrend and counter trend lines can be used for stop loss placement on a forward chart. However, it is very important to be able to place our stop loss at a comfortable distance above these boundaries. Nevertheless, because we're trading on the larger time frames, which offer larger pip movements, it offers the opportunity for re-entry, so that in case you actually incur an initial loss in trading a trend direction, you can actually take advantage of another trading opportunity until before the trend actually ends, so that you can actually capture a trading gain as part of that movement. Of course, it's very important to be able to accurately identify what is taking place in the market. And so it is very important to use the tools of trend lines and consolidation setups to be able to anticipate and predict what is taking place so that we can take advantage of the signals provided by the daily chart and the forward chart. Very important also to anticipate where the market is headed in terms of a specific trading target. In this case, the support price point of 1.2921 was the ultimate trading target. But of course, if you're trading on the smaller time frames, you might not have been aware of this important trading target. Stop loss, as I said before, should be placed comfortably above trend lines. This was the mistake made on the initial trade where the stop loss was a little too tight, and which was why we incurred that initial loss. And overall, in terms of the larger time frames, these offer us a lot more reliable signals and entry signals compared to the lower time frames, allowing us to take advantage of more trading opportunities with fewer losses over the long term. So larger trends provide us with reliable signals, and larger trends also provide us with the possibility of larger returns per trade, which can lead to larger rates of return on a monthly basis as well as over the long term. So this was a trading gain, 42 pips, 2% rate of return, which is a strong rate of return. And so over the long term, I think that once we continue to use a daily chart and a forward chart within the context of trend lines and consolidation setups, we'll be well on our way to providing ourselves with significant rate of return gains over the long term in this $1 trillion market. So of course, if you have any more questions, you can let me know about with regards to this trade or about my methodology in general. You can email me at shepherdduane@gmail.com, and you can also find me on Facebook as well as Baby Pips using the username and handle of DRFX Trading, as well as on Twitter using the user handle of @worldwide876. So that's it, traders, for this trading example on the pound US dollar. If you have any questions, you can let me know in terms of the overall approach and the rationale behind the approach that I'm now taking, which began in February of this year. So until next time, traders, all the best with your trading. And if you want to be a part of this journey towards these major trading targets, you can let me know. And I can sign you up, and you will receive the trading manual, my trading signals, video lessons, as well as Skype mentoring for VIP clients. So until next time, traders, all the best.